Thank you for joining us for the October 2023 Market Outlook webinar. I'm Kyle Wilson, Portfolio Manager here at SIA Wealth, and I'll be joined by PM and Chief Market Strategist Colin Szynski. Today I'll discuss our 4 BMO Global Asset Management sub-advised mutual funds. I'll highlight some asset allocation decisions as well as sector positioning, and we'll take a look at some absolute and risk-adjusted performance. Colin will follow that up with his market insights, highlighting the changing market conditions, including the impact of stubbornly high inflation, central bank positioning, and capital flows across asset classes. So we'll have a quick Q3 review, taking a look at the 4 sub-advised mutual funds here: the BMO Tactical Global Equity ETF Fund, BMO Tactical Global Asset Allocation ETF Fund, BMO SIA Focused North American Equity Fund, and BMO SIA Focused Canadian Equity Fund. Broadly speaking, over the quarter, we saw markets rally in July, followed by a retreat in August and September. Most major sectors retreated, with really energy being a lone bright spot for the period. In a down period for many markets, we saw outperformance in Q3 from the Tactical Global Equity Fund and Asset Allocation Fund, with the Focused Canadian performing in line, as well as the SIA Focused North American slightly lagging for the period. Over the last 6 months, we're really pleased with how these portfolios have done, seeing slight outperformance or performance in line with broad benchmarks and compelling performance versus peers. Additionally, at the end of the quarter, we saw significant deterioration in the SIA chart's equity action call, and in early October, this actually dropped into the yellow zone. As such, each of these portfolios rotated some equity holdings into money market to reduce risk. This would be 25% in the all equity portfolios and 15% in the asset allocation fund. Colin's market update at the end will go into some more detail about what the data is telling us. First, taking a look at our longest standing fund with the BMO Global Asset Management lineup, the BMO Tactical Global Equity ETF Fund. At the end of the quarter, we can see a 25% position in cash in the top right, followed by highest sector weights to technology, followed by industrials and energy. Performance was slightly down for the quarter, but still strong over the last 6 months, as we are still playing some catch up from lagging in Q4 2022 as well as Q1 2023, where our defensive positioning at the time lagged the initial rally in markets from a poor 2022. In Q3, we did see contributions to performance coming from consumer discretionary name Booking Holdings and energy name Global X MLP ETF, with detractors coming from Boeing in the industrial sector and the Spider Semiconductor ETF, both of which were removed in the period. We want to highlight once again the risk reward over the longer term for the fund, sitting in the low risk versus category while still maintaining average returns, as well as a category beating alpha and Sharpe ratio, which suggests that over the last 3 years, at least, this fund can be a strong diversifier as a sleeve within an overall equity portfolio to reduce risk and drawdowns relative to markets as well as other positions within your portfolio. Now looking at the BMO Tactical Global Asset Allocation ETF Fund, we see a slight negative for the quarter, but with the fixed income component adding some value in Q3. This portfolio has also been competitive year to date, which has helped the fund achieve a top quartile ranking on Morningstar Tactical Balanced so far this year. From a risk standpoint, the portfolio maintains below average risk versus category and average return versus the category, as well as a positive alpha and Sharpe ratio, both beating the category average. And we feel that this fund also continues to deliver competitive risk-adjusted returns over the longer term. With regard to the BMO SIA Focused North American Equity Fund, we saw a bigger drawdown in Q3, largely due to a select few security selection decisions in the quarter that were quickly reversed and sold. One example was Shopify. However, we did see contributions come from energy name Cameco and booking holdings from the consumer discretionary sector. The portfolio maintains 25% weight to technology, followed by higher exposure to industrials and consumer discretionary at this time. On a risk-adjusted basis, the portfolio maintains a positive alpha of 1.23, well above the category average of minus 3.52, and a Sharpe ratio of 0.4, exceeding the category average. This fund also sits in the low risk versus category while delivering average returns, once again highlighting the risk management benefits of our tactical approach. And the last portfolio to cover here is the BMO SIA focused Canadian equity fund. We also see a slightly negative performance for the quarter, but in between global equity and ZFN discussed previously. Year to date, this fund is also competitive on an absolute basis versus Morningstar peers, achieving top quartile performance so far in 2023. On the top right portfolio allocation, the highest weight sector right now is industrials, followed by energy, with a select few names in a few other sectors there. In Q3, we did see contributions coming from energy names, so Cameco and Athabasca Holdings were the top two, with detractors coming from Shopify and First Quantum Minerals. Both positions were removed in the period. And over 3 years, from a risk-adjusted basis, we're still very pleased with the outcomes. This portfolio maintains a category-beating alpha of 2.59, as well as a category-beating Sharpe ratio of 0.66. The fund also sits in the low risk versus category bucket while still maintaining average returns. So over the intermediate term, we're still very pleased with these outcomes on a risk-adjusted and absolute basis. And we believe that True Tactical is an excellent option for almost any investor to add some diversification and risk management to their portfolios. Now, the last couple of years have been really interesting from a True Tactical's perspective. So I just wanted to look at one of our funds as an example. So we're having a look at the BMO Tactical Global Equity ETF fund here. And the bars are the asset allocation changes over time. So the last three years or so has resulted in SIA being our most tactically active since the inception of the funds. We have seen some elevated risk signals over the past few years, starting in mid-2021, where the equity portfolios we managed did take some risk off the table. This was amplified then again in 2022. In the second half of 2022, we did have a slight shift in the portfolios back into equities, which was certainly not followed through on. Markets retreated again, and we took some more risk off the table. By the end of November, these equity portfolios had stepped back into a full 100% and remained there until the end of September 2023. Now, each of our equity portfolios has shown a similar pattern of risk management over the last couple of years. So this is just one example, but the benefits, I believe, can be seen in the risk-adjusted metrics that I discussed in the last couple of slides. And with that, I'm going to turn it over now to Colin to go through his market insights and discuss what he's seeing in the markets right now.
Thanks very much, Kyle. In the Markets Insights portion of this month's webinar, we're going to look at the two questions we've most frequently received from advisors over the last few weeks. The first one is, why did SIA Wealth reduce equity holdings and increase cash in late September? And the reason is that following the Fed meeting, we started to see significant changes in capital flows across asset classes, and a number of our shorter term indicators started to deteriorate, reflecting increased risk in the marketplace. And we've seen some of our longer term indicators start to confirm that into October. The second question was, why did SIA Wealth not add more cash? Why did we move our portfolios to 25% but not 50 or 75. And the reason was because even though we've seen risk become elevated, it hasn't become extreme. And although some indicators have turned bearish, some indicators have not. We've seen an increase in volatility, but not excessive. And we'll speak to that as we move through the presentation. First off, we'll take a look at the SIA chart's equity action call, which is a measure of equity market risk relative to other asset classes and capital flows between asset classes. As we can see, the equity action call spent most of 2023 in the green favored zone, which generally was an indication that equities were outperforming other asset classes. We saw, however, towards the end of the quarter that this started to drop within the green zone quite rapidly, and in fact, in early October, it fell into the yellow neutral zone. This is an indication of increased but not excessive equity market risk, but it is a point where we generally tend to become a little bit more cautious about equities which warranted the shift towards 25% cash. The shift in investor sentiment and capital flows between asset classes can particularly be seen in the changes over this year in the SIA chart's asset class rankings. In particular, we're going to look at the Q2 2023 and the most recent reading, which was from October 13th of 2023. And what we have seen most recently is that cash has moved up to the highest ranked asset class, an indication of investor caution and of capital starting to move out of equities. We've seen also in recent weeks, we've seen U.S. equities outperform relative to Canadian equities and international equities. The other area we've seen outperforming of late is commodities, which jumped up quite significantly over Q2 or over Q3 and into Q4. And that was driven primarily by a large resurgence in oil over the course of the summer, and more recently joined by gold as well. Bonds, meanwhile, dropped to the lowest ranked asset class, and that's a function of that bonds, of course, tend to move in the opposite direction of interest rates. And as we've seen Treasury yields climb over the last few months, we've seen bonds in particular get hammered pretty hard. As I mentioned, there was a significant shift in sentiment among investors towards the end of the Q3 in September, and it was sparked primarily by the U.S. Fed meeting, and in particular the Fed's outlook for interest rates for 2024. In previous forecasts, the U.S. Central Bank had suggested that they might cut interest rates by up to 1% in 2024. In their most recent forecast in September, they cut that back to 0.5%. That was an indication of interest rates likely to remain higher for longer. That was a headwind for equities, and on the other hand, a big tailwind for Treasury yields. That sparked a big rally in Treasury yields. And the reason for this and why the central banks have become a little more hawkish is shown on this slide. Inflation hasn't come down fast enough. It hasn't come down as quickly as they had hoped. It has come down, but more recently we can see that on the left-hand side is the consumer price index for a number of countries, and we've seen, especially this month, that a lot of them have leveled off, that inflation has stopped going down, and certainly not going down as quickly as central banks had hoped when they were talking about cutting rates next year. On the right-hand side, we look specifically at U.S. inflation, and we can see that while the Fed funds, which is the yellower line, and has caught up and surpassed the consumer price index, the blue line, it's closed that gap, and it is higher, which is a tightening environment. We can see if we look at the gray line, which is hourly earnings or wage inflation, and the orange line, which is core PCE inflation, which is the measure that the Fed looks at, they've come down more slowly than CPI. So what this is indicative of is that although inflation is not as badly out of control as it was a year ago, what we are seeing though is that the central banks still have quite a ways to go to really tame inflation, and wage inflation is a particular problem because we've seen a lot more labor unrest, a lot of unions going out on strike and demanding significantly higher wages to catch up with inflation. But if you do that, then inflation becomes more entrenched, and that's a big concern for central banks at this point in time. Which is why we can see on this slide, which measures the benchmark interest rates for a number of central banks around the world, that although interest rates have gone up, they've now stabilized. And now we're at a question of some central banks have left the door open to further interest rate hikes if needed. Other central banks have just kind of said that they're on hold and data dependent, but nobody is really talking about cutting interest rates at this point in time. And that's particularly significant. It means that just as inflation has remained elevated, interest rates may remain elevated for some time to come as well. This chart here shows the significant changes in investor sentiment that were sparked by the Fed meeting, which we mentioned. The orange line is the US 10-year Treasury note yield, and we can see in September how it spiked up significantly. And conversely, the purple line, which is a bond ETF, collapsed, and that was quite significant. At the same time, the green line was the US dollar, sparked by higher interest rate, rising Treasury yields. The US dollar started to pick up as well, and we can see at the same time, moving in the opposite direction of the dollar, we have the S&P 500, which is the gray line, and the black arrow, which declined significantly through the latter weeks of the quarter. This decline in the markets, which started in August and accelerated in September, was not limited to the United States either. In fact, it was a global downturn for equities, a broad-based retreat. We see that both the U.S., Canada, developed markets, emerging markets, all have been trending lower for the last number of weeks. Another measure that we look at too when we're trying to determine whether something is a widespread trend or limited to a smaller number of stocks is what happens across various asset classes. And in this case, we can see that between March and the end of July, we had large caps, mid caps, small caps, all kind of advancing together. In fact, the blue line is the Russell 2000. We can see that small caps lagged initially in the summer. They were kind of trending sideways and then caught up towards the end. And that's pretty common in bull markets. Now here, in a more bearish turn in the markets, we've seen the small caps, which are generally considered to be riskier, more emerging kind of companies, have sold off faster than the large caps. But let's be clear, large cap, mid cap, and small cap stocks have all been declining in tandem, which is indicative of a broad-based retreat in the markets. As I mentioned, the sell-off started in late September with a shift that was related to monetary policy and interest rates. However, in the last few days, with the breakout of hostilities between Israel and Hamas, we've also seen that geopolitical risk intentions have also now taken a role in influencing investor sentiment. And where we've seen this particularly is in stocks, in gold, and in oil. Let's start with oil, which is the blue line. This one was quite interesting because oil has been rallying throughout the summer, starting back in July. And when equity markets first turned down in September, oil kept going, and it seemed like it was defying gravity for a couple of weeks. And then oil had a sharp correction at the end of September and early October, basically catching up to the declines we had seen in equity markets. However, in the last few weeks since the fighting started between Israel and Hamas, we've seen the oil price start to take off again. The other thing we've seen is in the price of gold. Now, through the summer and particularly late September, as the U.S. dollar was climbing, its nemesis, its natural enemy, which is gold, was steadily declining, and gold was getting hit pretty hard towards late September. However, in October, once the war started, we've seen gold have a significant resurgence. This is indicative, like the increase in shift in capital flows to cash, the rally we've seen in gold is a shift in capital and a shift in sentiment towards investors seeking safe havens, investors seeking cutting back on risk exposure and looking for less volatile parts of the market and stores of wealth and places to store their wealth through more volatile times. We like to keep this slide in and mention it in our presentations as a reminder for investors that sometimes we don't want to watching and getting caught up in the hype, and be careful what people are wishing for, because falling interest rates are often a sign of a weakening economy. That in fact that the central banks feeling confident enough that they can keep rates higher for longer is also underscored by the fact that economic data has held up pretty well. Things like retail sales, employment, even though inflation has been high, the other measures of the economy have held up pretty well, and so that's actually a positive environment for corporate earnings. But what we want to watch for here is if we do start to see interest rates suddenly start to come down, be careful because that has coincided with weakening economies and bear markets in the past. Although certainly there are a number of reasons out there for investors to be a little bit more cautious, and we're seeing more cautious capital flows out there in the across world markets and across asset classes. At the same time, while there's more caution, there are indications that perhaps there's not a reason to just to panic at this point in time either. So far, we seem to be in a sizable correction, but not necessarily a downturn at this point in time. Hence, we are in the neutral part of the equity action call rather than an unfavored part. And the first one we'll look at here is seasonality and put the recent market action into context. In this chart, the blue bars on the left hand side of each month are the long-term average return for each month of the year for the Dow Jones Industrial Average. The red bars are the returns for each month in 2022. The green bars are the Dow each month so far in 2023, and the purple bars are the S&P 500 each month so far in 2023 as well. And that's because we've seen the occasional divergence between the Dow and the S&P over the course of this year. Now, what we want to look at in particular, I'm looking at July, August, and September. We saw that July, which is historically a favorable month for stocks, was a pretty good month for stocks this year as well. Perhaps not quite as pronounced as in 2022, but then if we look at August and September, we can see that we did have a significant seasonal declines in both August and September for both the Dow and the S&P, but although these declines were worse than the long-term average, they were not as bad as 2022. They were not as pronounced as 2022. 2022 is an extreme year, both to the upside and to the downside for seasonality. This year it's still playing out, but it is more moderate. And if we look to October returns so far, we can see that October historically is a positive month for the markets, as is November. And what we saw last year was we had a terrible September, fantastic October. This year we've had a tough September, and so far we've had a moderate improvement in October in line with the historical average return so far. Also, we thought we would take a look at the presidential cycle. The third year of the presidential cycle, which we're in now, is historically one of the strongest years in the cycle for world markets. It's the time when U.S. politicians are starting to set their sights on trying to get themselves and their parties reelected. So what we saw in the third quarter was for the Dow a decline of 2.5%. This was a little bit more than the long-term average of year three third quarters of 1.1%. So it is not unusual for that particular quarter to be down. It was down, but not as much as some of the worst quarters, and just a little bit more than average. So let's call it a moderate decline. If we take a look at the three worst quarters, third quarters of year three was 1999, 2011, and 2015. And in all three of those cases, you had a significant rebound in the fourth quarter that essentially clawed back all the previous quarter's losses. And if we look at 2023 so far, we had a 2.5% third quarter loss, and to October 17th, we had a 1.5% bounce. So the markets had already actually clawed back a good portion of the third quarter loss. Now, what we're really keeping an eye on here is what happens over the full quarter. Because as we can see of the quarters studied, there was only one fourth quarter of year three that was negative. And that was 2007. And that was then followed by a massive bear market in equities that ran through all of 2008 and into 2009. So the question we're kind of asking ourselves now is, are we in a 2011 or 15 kind of situation, or could we be looking at a repeat of 2007? So as the quarter plays out, we look for, do we get a seasonally strong quarter as we often do based on where we are at the time of year and in the presidential cycle, or do we buck the trend and have a negative quarter? If we have a negative quarter, that could raise some red flags for next year. We'll see what happens. We continue to monitor this situation. Now we're also going to take a look at what we call the sector scopes, which is a feature on SIA charts. And what it does is it measures the bullish percent for 31 different industry groups. So this is the percentage of stocks within each industry group that's in a bullish pattern. And so on the left hand side is like 0 to 15, 15 to 25, to 30, and so on. And when we see this, as we have here at the beginning of October, all the sectors piling up on the left-hand side, that was indicative of a bear market, of a bearish downswing in the markets, that all the sectors had pretty low bullish percents, which means that most stocks within these sectors are on bearish signals we're on bearish signals at the moment. Now, when you're on the left-hand side, it's often indicative of a declining market. When you're on the right-hand side, it's indicative of a rising market. But when we get to the extremes, can be an indication of that we're getting overbought or oversold. In this case, by the 4th of October, we were seeing a lot of these sectors starting to pile up in the two leftmost columns, an indication of a falling but perhaps getting oversold market. And now, if we look at the sector scopes for almost 10 days later, October the 13th, we can see that a number of sectors have moved their way back rightward. In fact, there's now no sectors in the leftmost column at all, and this is an indication of a short-term bounce in the market. Although overall we still see the majority of sectors are on the left-hand side, we may not be perhaps as oversold as we had been. And some of the things that have rebounded in particular. Energy, metals started to come back. Utilities had shifted rightward. That's a sign of that the treasury yields were starting to level off. Interestingly, insurance, which is a sector that had outperformed previously, has remained among the stronger sectors. Some of the weaker sectors we're seeing at the moment are still some of the interest sensitives, the banks, real estate, some of the industrials. Autos are getting impacted by strikes, transportation getting impacted by rising energy prices. Some of the defensive areas, tobacco, food, also continue to struggle. Another indicator that we like to look at for confirmation of changes in investor sentiment and in particular in investor attitudes towards risk is the VIX, which measures the implied volatility in S&P 100 index options. So a rising VIX tends to indicate increased fear in the markets. A falling VIX tends to indicate increasing confidence among investors. But if you get too low in the VIX, that can be a sign of complacency. If you get higher in the VIX, it can be a sign of extreme fear or outright panic. What we've seen in the VIX recently was that it was pretty low over much of the summer. We've seen it climb back up a little bit and perhaps break out of a downtrend, but so far the VIX still remains below 20, which is a relatively low compared to where it's been over the last 3 years. If we were to see the VIX continue to move up into the 20 to 35 range, where it spent a good chunk of 2021 and 2022, that would be indicative of weakening investor confidence, of investors becoming more cautious. And of course, we're still well short of the panic extremes that we saw back in 2020. Finally, we'll take a look at sector relative performance among sectors as an indication of changes in investor sentiment. If we look on the rightmost column at year to date, we can see that utilities has been one of the worst performing sectors. That's related to being interest sensitive in a time of rising interest rates. The best performing sectors year to date have been industrials, technology, and energy. If we look at the most recent 3 months, we can see, though, however, that we had a significant pullback right across the board, and with the exception of energy, which has benefited from rising energy prices. In the last month, we've actually seen all sectors turn down. That's indicative of the sell-off that we had seen in late September and into October. But if we looked at the last week or so, we're back to a little bit more mixed performance as we had a bit of a bounce in the markets. energy and materials continue to outperform, but we did see some of the pressure against utilities and real estate start to ease a little bit, and industrials just kind of holding their own. So we're moving now into earnings season, and as focus starts as we add into the mix results from companies across comparing them across their industries, we may see some changes as we in relative sentiment towards different groups.
And with that, that wraps up the Q3 and October 2023 Market Outlook webinar. Thanks a lot for your insights there, Colin. Some really great information there. Here's a list of our funds that we sub-advise for BMO that were mentioned earlier on the call. If you have any questions, please do not hesitate to reach out to one of the team. We're always happy to chat and answer any questions that you might have. With that, we'll just flip up our disclaimer here. So once again, thank you very much for your time today and enjoy the rest of your week. Thanks. Take care.